In January 2026, land registry data confirmed something that stunned a lot of people who thought they were sitting on safe investments. The average price of a flat in London had dropped by £19,000 in a single year. We're talking about a fall from £450,000 in January 2025 to £431,000 by January 2026. That's a 4.2% wipeout in 12 months. At the same time, and this is the part most people are missing, Knight Frank's Country House division closed £173 million worth of prime rural sales in just the first quarter of 2026. 36 transactions, 8 of them above £5 million. Buyers relocating out of London, snapping up Grade 2 listed manor houses in the commuter belt. So something is shifting. Investors who used to park their money in a central London flat are looking at the numbers right now, and the numbers are sending them somewhere else entirely. Let's break down exactly what's happening and why. To understand why investors are leaving, you have to understand how bad the central London flat market has actually gotten. Start with the data. London flat prices have fallen roughly 7% since early 2023, according to chartered surveying firm Prince Surveyors, and that drop isn't spread evenly. Inner London flats, the kind of 1 and 2 bedrooms in Tower Hamlets, Fulham and Greenwich, have seen the sharpest hits. The average inner London flat has fallen 6.2% in just the last year alone, wiping around £35,000 off a typical property. In Fulham specifically, you could have sold a flat for £450,000 in 2016. Today, that same type property is worth around £443,600, less than a decade ago, adjusted for nothing. That's before inflation even enters the picture. Now, here's what's driving investors toward the exit. 3 separate problems hit at the same time, and they compounded each other. The first one is leasehold costs. Over a third of London's homes are leasehold. That means buyers don't actually own the land, they own a lease, and they pay service charges on top. According to estate agency Hamptons, average service charges in London have now hit £2,800 a year. Some central London developments are charging between £5,000 and £10,000 annually. And those charges are making flats nearly impossible to mortgage and nearly impossible to sell. Campaign group Free Leaseholders went in front of a parliamentary select committee in March 2026 and said more than a third of flats in the UK now face serious selling difficulties because of this issue. Harry Scoffin, who leads that campaign, put it plainly: there is a crisis in the flats market at the moment. People cannot sell, they cannot move on. Mortgage lenders noticed. Several have now tightened their criteria and are refusing to lend on flats where service charges routinely exceed certain thresholds. That creates a vicious cycle. You can't sell to most buyers because most buyers can't get a mortgage on it. The second problem is cladding. Since the Grenfell Tower fire in 2017, trust in high-rise apartment buildings took a serious hit. The Building Safety Act 2022 introduced new obligations on building owners and developers, with courts in 2025 ruling that protections apply retrospectively, going back to 1992. Remediation is ongoing, and for properties still caught up in the process, lenders are still nervous. An EWS1 form, the Fire Safety Certification, is now a standard demand before any mortgage is issued on a flat in a taller building. The third problem is policy. The Renters' Rights Act 2025 became law in October 2025 and came into full force on 1 May 2026. Section 21 no-fault evictions are now abolished. Rent increases are capped to once per year. Fixed-term tenancies are banned. For London landlords, who were already getting squeezed, this was the final straw for many. Savills published data in early May 2026 showing that former rental homes accounted for 30% of new sales listings in London over the year to March 2026. To put that in context, across the rest of Great Britain, that figure was 13%. London's landlords are selling up at twice the national rate. Now let's talk about where this is heading. The commuter belt has been pulling buyers away from central London since the pandemic reshaped where people want to live. But what's changed in 2026 is who's buying and what they're buying. It's not just families chasing school catchments. Investors and high net worth buyers are now actively targeting Grade 2 listed country houses and manors within an hour of London. Grade 2 listing is a government designation for buildings of special architectural or historic interest. There are roughly 370,000 of them in England. For buyers, they represent character, permanence, and, critically, scarcity. You can't build a new one. Knight Frank's Country House division recorded its strongest Q1 in years. The head of their National Country Department, Edward Rooke, said the results reflected a market increasingly driven by lifestyle-led buyers, including families relocating from London and international purchasers seeking a long-term UK base. The average guide price across those 36 Q1 2026 sales was £4.8 million. The largest single transaction came in at £23.5 million. These aren't trophy purchases for vanity. Buyers are doing the maths. Hertfordshire is a good example of how this plays out at the county level. Between February 2025 and February 2026, London's average house price fell from £561,072 to £542,304. Berkshire dropped 1.6%, Surrey dropped 1.1%, but Hertfordshire actually held up. Andy Morrison, Director of UK Property Development, told Property Investor Today that Hertfordshire has firmly established itself as the premium commuter county for London buyers. Fast rail connections, St Albans is 18 minutes from London St Pancras, combined with larger homes and strong schools, have kept demand solid. In the Chilterns, Knight Frank's own agents describe the area as offering the best of both worlds: countryside, good commuter links, and strong schools. 4-bedroom homes in well-connected commuter towns are now starting at around £900,000. That sounds expensive, but compare it to what you're getting versus a £431,000 flat with £5,000 annual service charges, cladding uncertainty, and a landlord-unfriendly legal regime in Zone 2. Savills has pushed demand from the commuter zone even harder in their 2026 forecasts, specifically calling out Surrey's chronic undersupply, commuter demand, and lifestyle appeal as reasons it is in a stronger position than much of London. Their long-range forecast, covering 2026 to 2030, projects an annual return average across UK prime real estate of 7.8%. Private rents in commuter belt towns are also running at 6 to 7% annually, outpacing many central London postcodes, according to ONS data cited by investment firm TK Property Group. That's before you factor in the lower entry costs. A flat in St Albans averages around £328,000, £100,000 below the London flat average, even after the recent price falls. So why is Grade 2 listed in particular? This part of the story doesn't get discussed enough. In November 2025, Edgeworth Manor, a Grade 2 star-listed property in Gloucestershire set in 56 acres of Victorian gardens, sold for around £11 million, handled jointly by Savills and Knight Frank. It had been on the market since 2022, 3 years, and it's still sold at guide price. That's the thing about properly located, well-priced listed properties. They don't drop the way a leasehold flat in a high-rise does. The supply is genuinely fixed. You can't manufacture more Georgian farmhouses or Victorian rectories. And the demand for a particular type of buyer, established families, international buyers building a UK base, people wanting real space after years in a central London apartment, is growing, not shrinking. The cladding issue doesn't exist on a 1740s stone manor. The leasehold problem doesn't apply. These are almost always freehold. The Renters' Rights Act still applies if you're renting them out, but the tenant profile is completely different, and the yield conversation is different too. There are real-world costs to Grade 2 ownership that buyers need to factor in. You can't change windows or extend without listed building consent. Renovation costs run higher. Insurance is more complex. But investors who've done the calculation on a central London flat, service charges, cladding liability, tax changes and falling prices are looking at a renovated Georgian manor with 3 acres in Surrey or Hertfordshire and saying the numbers actually work better here. As James Cleland, head of country sales at Knight Frank, said in April 2026, with buyers continuing to prioritize quality, location and long-term value, the first quarter has shown that correctly priced prime country homes continue to attract competitive interest. Geopolitical noise didn't stop those 36 transactions from completing. Here's the situation as of June 2026. London's flat market is under real structural pressure: leasehold costs, cladding uncertainty, a new tenancy regime, and a 5% stamp duty surcharge on additional properties that came in after April 2025. Overseas investors in prime central London new builds are down 53% compared to 2015. 30% of new London sales listings are former rental properties. The numbers are hard to argue with. At the same time, the prime country house market, specifically Grade 2 listed properties within commuter distance of London, is posting its strongest transaction volumes in years. Lifestyle buyers and investors are arriving at the same conclusion from different directions. The value is no longer inside the M25. This doesn't mean central London is finished. The rental market there still has demand, and new leasehold reforms are slowly working their way through Parliament. But for investors doing a cold calculation right now, looking at yields, capital growth forecasts, regulatory risk, and resale liquidity, a Grade 2 listed commuter manor is winning that argument in a way it simply wasn't 5 years ago. That's a shift that every homeowner, renter, and investor watching this market should understand, because once that capital starts moving in a direction, it doesn't reverse quickly. Everyone's watching what happens next.